Hey guys, welcome to the ARMR Report. Your host, Brett Rosenthal. This is a show about stock market investing in the millennial age. That means that we use traditional fundamental analysis to develop our investment ideas, but we use millennial tools to execute things like algorithms and exchange traded funds and all the things that your dad, your granddad never had access to. It's dramatically changed the way the market behaves. Now, this is a live trading desk, and so I have algorithms that are running myself, both day trading algorithms that run automatically, and then we have algorithms that work on a multi-day basis that help us put on risk appropriately and take off risk when necessary. What I like to do on this show, I'm distracted right now for a second. Sorry, the show just started. I am managing my own capital here, right? So all of the information I impart to you comes from 30 years of doing this, both professionally and for myself personally. We have an affiliation with Interactive Brokers. We have all of our capital there, and we have 3 model portfolios that our clients link to whether it be conservative, balanced, or aggressive approaches to investing in the stock market with the aid of algorithms, which I think is the best of both worlds. It's not automatic execution like you hear about so much today from an investing standpoint. On a day trading level, we automatically execute. We have targets and stops and all those things. But on a multi-day level, we use algorithms to tell us when to add risk, when to take risk off. And so you can use this in your own portfolio. I do this every day from 12 to 12:30 to try to help you understand what algorithms can do to protect your capital and increase your net worth in a meaningful way and outperform the averages. So I'm here kind of discussing why it's important to actively manage your portfolio as opposed to passively managing it. I started doing this show in August because, look, for almost a decade, passive investing was the way to put money to work. You had a Fed that was out there supporting the market. You had central banks out there doing quantitative easing in an unlimited degree. Well, I think probably after 2011, 2012, you had the QE Unlimited started, and then we just had a run of probably 5 years of buy and hold passive investing that dominated the landscape. And really put a lot of hedge funds out of business, put a lot of smart money out of business, put a lot of the guys who are using technology and using algorithms to hedge portfolios out of business. Because what's the point of hedging if you have unlimited unlimited demand for the equity markets coming out of central banks that they can just print capital however much they want? So the US Fed, the European Central Bank, the Japanese central banks, they were just adding liquidity at a constant clip. So you can sit back during periods like that in history, and there's very few periods like that in history. Probably maybe none. I don't know. It never happened before in history where for that long central banks were just adding liquidity with reckless abandon. You could get away with passive investing because you had this huge updraft from central banks. What we don't have now is the updrafts from central banks. And so I've started doing this podcast every day. I'm streaming live on YouTube every day. I'm aggressively reporting what our actively managed algorithms are telling us about risk and reward every day at 12 o'clock for your benefit. I'm trying to wake you up. If you've made a lot of money in the last 5 years because of central bank largesse, then don't give it all away because you think that's how money can be run. It's not. Don't be caught like so many lemmings off a cliff as this market grinds you down in a bear market that we're now in. Risk management is going to be key. So I started this in August. And I came out in September, late September, and says, time to protect capital. And our algorithms are telling us, risk off. You can follow what our algorithms are saying on our website, rosenthalcapital.com. And you'll see that there's a real-time risk on, risk off monitor that I have there for your benefit. We have 5 major indexes that we follow to guide all of our risk on, risk off investing. The S&P, the Dow, the NASDAQ, the small cap, and the momentum index. Those 5 ETFs, we have proprietary algorithms designed to tell us when the probabilities and statistics are in our favor, when the reward is worth the risk, and then we put capital on, or if the risk is too great and the reward's not significant enough from that point, we take risk off. So we started doing that late September and mid and small caps. We were aggressively telling you to get out of the market at the beginning of October as the other bigger indexes started to follow the small cap index. And, you all can go back and look at the podcasts and see what we've been talking about. But suffice it to say, for those of you who've been following me for a while, thanks for being here. You're helping me out just as much as I'm helping you, I hope, because it keeps me honest. It keeps me straight. We had a huge day yesterday. I hope you guys joined me in this. It's so rare that you get day trading opportunities like this. Most of the time, when you're in a bull market and the market goes up 80% of the time, the intraday volatility is smaller. And so it's hard to make a lot of money intraday. And I don't recommend it. But in bear markets, God, that's the time to take day trading risk because the reward is so great. And yesterday was a perfect example. I tried to tweet it out to you as I was doing it to get you involved if you could. I was using S&P puts, calls. I was buying calls on the ETF SPY at 11:06 yesterday. Let's go back and look at my Twitter feed. Hashtag ARMR Report. We were up 129% by the end of the day. We rode it all the way. We literally almost bought the bottom of the market and we sold it right at the end of the day at the top of the market. How'd we do that? Well, we look for locations and we look for weakness in the morning. And when we get locations and weakness in the morning that line up, we have triggers. This is all algorithmic now. We've written the code to put it into the computer and say, look, when these triggers show up, get involved. I'll give you one example of a trigger today. For those of you who like to day trade, here's a trigger that you can bank on when you're in a downtrend. And it looks like this. When the market is down for more than an hour, and I mean significantly down, and we judge that by Fibonacci extensions. How many down does it go? We have our own proprietary extensions. You could probably use them off, just basic charting analysis, just to give you a basic guide. So I'm going to give you this gift here of what trigger we used yesterday to get long the market right near the lows. You'll have to refine it for yourself because you don't have my algorithm. You don't have access to the proprietary VWAPs that we use and Fibonacci extensions that we use. But you probably could take off-the-shelf VWAP, off-the-shelf Fibonacci extensions, and if you work with them, come up with some type of a trading strategy. I'm not sure it'd be as effective as what we're doing, but I mean, that's because I've been doing this a long time. It's been 30 years I've been writing code in one way or another when it comes to trading equities. So I'm just going to give you a gift and a thought. When the market is in a major downtrend like we're in now, and you have big downside moves over an hour-long period, and then you have a crescendo of selling on a volume spike, that's the time to look long. It's at a time when the market looks the most bleak. That's the time to look long. When that volume spike hits and the market's making a new low on the day, you follow that bar. Now, we use 3-minute bars. Okay, you do whatever you want. That's what we do. When the market price closes, I'm talking about the S&P now. You could be trading the Dow, the NASDAQ, the small cap index, whichever you want. You have to determine what you think a volume spike is. I have my own calculations. When there's a volume spike, X amount of days or bars back is your average volume. How many bars back you want to look? What's the average volume? And then how much does the spike have to be? When we get that spike, we get a new low on the day. We've been down for more than an hour. It's more than a couple Fibonacci extensions, so it's definitely a downtrend. That spike, which has got everybody else running for the hills thinking, here comes the big selling. If the market closes above the high of that volume down bar, put your capital to work. And that has to happen within 6 or 7 trading bars. So if we use, it could be 5 bars, maybe 15 minutes. Within 15 minutes, you got to close above. Sometimes a little bit longer, the shorter it is, the better. If it's the very next bar, that's outstanding. If it's 2 bars later, fantastic. The longer it takes, the little more sketchy it becomes. But somewhere around 5 bars is your cutoff. It takes place 7, 8, 9, 10 bars later, it doesn't count. I don't trade that. I'm looking for a plunge and a reversal that trapped everybody on volume after an hour-long selling. That was the trigger yesterday. It happened on every index. The S&P, the NASDAQ, the Dow, the small caps. They all did the same thing and then reversed. And it was that reversal within 6 minutes. It was 2 bars or 9 minutes. I think 2 bars. And then the 9th minute is when it closed above the high of that volume bar. That was the signal. We bought our calls. 129% profit in a day. Not bad. I don't day trade every day. I'm not looking for little moves. I'm looking for locations. Yesterday's location was the low of the previous day. That's a great location. And then look for reversals. That's how we did it yesterday. I'll let you know when I'm doing it again. If you want to get updated on a more frequent basis, as opposed to just watching my Twitter feed, which I can't update constantly, but every now and then, if it's something important, I try to do it. We do have an email list. Go on our website, rosenthalcapital.com. Sign up for the email alerts. It's free. And when we have setups like that with our day trading algorithm, we'll let you know with the email alert. We'll also use that email alert for our multi-day investment strategy. So you'll get alerts when we have our risk on across the board, and we'll let you know where we're putting capital. Okay. Hang on a sec. It's a live trading desk, guys. Sorry about that. Hey, I'm in the midst of it. You need me right now? How's he doing? Oh, brilliant. Okay, well, I am. 406. Yeah, exactly. Okay, love you. But try the cell probably, because she may be down with Layla. Okay. My mom says hello, everybody. Had to take that call. My son's not feeling well. He's 5 years old. Got a bit of the flu, I think. And my mom's helping out, taking care of him right now. But I digress. Call from Rosenthal. So let's move on. I talked about how we did the day trade. I talked about what our big averages are saying right now. Our 5 index algorithms we have are still telling us to be risk off, and that's the place we've been in since the 4th of December. Nothing changes just because we have a huge up day. None of those algorithms are telling us to get long. Which brings me to my next point, and that's rule number 27. If you go to the website, click on algorithmic research, you're going to see a rules of the road blog post that I'm putting up and I'm continuing to add to over time. I've been doing this 30 years, and I'm gifting to you hard-fought information that I've learned on that blog post. Rule 27 comes into play right now. This is big. Rule 27 states that in a downtrend, which we're clearly in now, the market can go up 2 days in a row, and it means literally nothing. It won't change our algorithms on a multi-day level. It won't get me to start thinking the market is bottomed. 2-day rallies mean nothing. And sometimes the rally's so huge day one, like yesterday, that's the whole 2-day rally. It just happened, a huge up day. You know, if the market was up 2.5%, 3% yesterday, it might have been up another 2.5%, 2% today. Then you'd have your 5% move and the 2-day rally would be over. Yesterday, we had a 5% move. And today we've gapped down and we're trading lower all day. So that whole move is over. Although it could be up today. We'll see what happens. But it won't mean a thing to me. It's day 3 that matters. You need 3 up days in a row to suggest a trend change is possible. So nothing yet, guys. Don't be looking at the last 5 years and saying to yourself, I always bought the dip and it worked, and that was a big up day. I should get involved now. No, not yet. This is not the last 5 years. The last 5 years, the Fed was adding liquidity. On my Twitter feed today, I put up the post. And I said, I just want to read it to you. $600 billion of Fed liquidity reduction is slated for 2019. $600 billion. Fed Chairman Powell said they are not going to touch the balance sheet roll-off portion of what they're doing. It's on autopilot. That, my friends, is why the market's down. It's not because Donald Trump makes a tweet. It's not because China's doing something horrific. It's not because people are trying to figure out next year's earnings and PE state. It got nothing to do with that. It has everything to do with the Fed reducing liquidity to the tune of $600 billion in 2019. And they were doing it this year. So we have a bear market that started this year, advancing into next year. And if the Fed continues on the path of $600 billion in reductions of liquidity, you better believe the market's going lower, and you better wake up. Passive investing is over. The next 5 to 10 years will be dominated, the success will be dominated by active money managers, active individual investors who are using algorithms to add and subtract risk at the right time. 600 billion is a big figure. When you figure the market was like a Coke addict and it needed more and more and more liquidity to keep going higher and higher and higher. So even if we were just at flat, no reduction, just flat, the market would have sold off. We're having a reduction of 600 billion. Unless the Fed changes that, this market's going a lot lower. So be on the lookout for Fed changes. Who knows? Maybe the Fed wakes up, makes a change. But that is a major paw print. 600 billion reduction, bear market paw print. Another paw print. Small cap stocks continue to lead the market lower. There won't really be a massive rally that lasts for a long period of time if small caps don't participate. You can get a huge up day in the Dow. You could even get a rally for a week or two. But as the rally unfolds in the big cap indexes, if you're not getting confirmation out of small caps, then it's not going to last. Small caps were the harbinger of the bear market that started on the 24th of September when I told you on these podcasts it's time to go to cash because small caps were collapsing. And this won't end until small caps either lead the market out or at the very least join the market out. But when you get big caps that rally and the small caps can't go anywhere, the big caps just head right back south. Major paw print. Don't forget it. Okay. Also, another major paw print I wanted to share with you, and I've been tweeting about this today, but bear markets, one of the major paw prints of bear markets is massive volatility. Massive volatility. That's not a good thing. That's not, oh, the markets are almost at a low. Oh, the markets are bottoming. When you see massive volatility, it tells you paw print. Small caps underperforming, paw print. These are the things that let you know the market's in a bear market. If you go back and look at my Twitter feed, hashtag ARMR Report from this morning, I broke it down for you. It's a great story in the Investor's Business Daily. I broke it out for you just so you can understand this. We can go back to 1933. Market rose 15% in one day. That was the single biggest gain ever. Market suffered after that. 1931, the Dow was up 14.87% in one day. You know what happened in the 30s? It was an awful bear market. Huge up days. 2001, you say to me, Brett, 1931, forget it. The market's changed dramatically. Okay, let's go to 2001. The NASDAQ was up 14% in 2001. Then it rolled over and collapsed, dropped 44% in the next 6 months. Okay? Paw print, major paw print. Let's keep on going. I'm not going to take you to 1929. You can do that if you want. The Dow was up 12% in one day. That was the crash of 29. Oh, yeah. Let's go to 2008. 2008 is a great one. Market was up. The NASDAQ was up 11.8% in 2008. In one day. I think that was in August. Market collapsed after that. Oh, look at 1987. The Dow leaped 10% in one day during its crash. We were only up 6% in the NASDAQ and 5% in the S&P yesterday. That is not even that big of a day compared to these other examples. But they're all big up days, big point jumps. And they were all in the midst of big bear markets. And they all resulted in lower prices taking out those lows in the coming weeks and months. It's a major bear market we're in, guys. Don't forget it. Follow the paw prints and behave in a manner to protect capital now. Capture upside on big down mornings. If you're carrying a lot of cash and there's a big down morning, you look for reversals at key locations. I'll try to update you on Twitter and help you out with that. It's a hard thing to do. And I don't recommend day trading for everybody, by the way. Nothing wrong with just sitting in cash, waiting for the next opportunity, waiting for the volatility to come down, market to base, start to get good breakouts of quality companies. You start putting money back to work when I have a risk-on opportunity. All right, let's get to precious metals before the show's over. Precious metals do act a bit like a short at the moment. So when the market's up huge like it was yesterday, they beat up the precious metal stocks. But what happened yesterday that was incredibly important to the bull story on precious metals? If you look at our website, you can see real-time risk-on, risk-off monitor tells you we're focusing on gold and silver and the mining companies. Scroll down the homepage, you'll see what our model portfolios look like, and each one of them has 15% exposure to precious metals investments. And each one's a little bit different depending on the type of account we're running, balanced, conservative, or aggressive. But the one thing that was missing in the bullish case for precious metals up until yesterday was that silver was not going up. And it's just very odd for gold to be breaking out and precious metals mining stocks to be breaking out and silver, flat, right near the lows of decade, And yesterday, silver broke out in a big way, joining the party. Even though they took down GDX, right? Gold stocks, it's like a algorithmic trade. When the market's up huge, 5% on the S&P, they dump the GDX down 2.5%. Don't worry about that intraday swinging around mumbo jumbo. We have a nice uptrend in GDX. There's a lot of volatility in GDX. You got to live with it. Take a smaller position if you don't like the volatility. Don't make your stop too tight. You'll miss the move completely. Just reduce your position size if you have to. But while they were beating up the gold stocks, silver was up over 1%. Gold was relatively flat and stable, even though the market was up huge. Now what's happening today? Market's getting whacked. Gold and silver. Silver's up another 1.33%. Gold is up another 0.8%. And the mining stocks are back up over 1%. Okay? So they had a really great day yesterday in the midst of a wicked up move in the rest of the market. They held on to the bulk of their gains. You saw the metal itself adding to gains. And you saw silver catching up. All of these things were necessary for us to, if we're looking for bear paw prints from a stalking the bear standpoint, we're looking for hoof prints when it comes to the bull market in the metals. And that was a big print yesterday when silver broke out, joining the party. But you can expect on an intraday basis, and don't be thrown by this, you can expect if the market's up huge, then gold stocks will sell off. At some point in the bull market in gold stocks, the market will be up big and gold stocks will be up big with the market. And then you've got the bit in your teeth. But we're right at the beginning of a whole new upcycle in gold and silver stocks. We're breaking the downtrend that goes back to 2012, maybe even further, 2010. The highs 2010. That's just happening this week. It's early, guys. So we continue to focus on that space. And I would submit to you that's probably another paw print of stalking this bear market when you start to see money go into the precious metals in a meaningful way. It suggests that as money escapes the stock market, it's looking at places to hide, and it's finding gold and silver in the mining stocks. Another paw print. All right, listen, guys, thanks so much for spending time with me today and giving me your ear for half an hour. It really helps me. It orders my thinking. It makes me a much better trader. I can't wait for the next 100+% return on my money in one day trade. I'm looking for it. I'm searching for it. I'll share it with you if I find it. All right, you guys have a safe day out there. Don't do too much. Don't force it. Let the market come in. Let it come to you. Do your homework. Do your research. I've started to nibble away on some of these marijuana stocks. They look awful. They didn't even participate in yesterday's rally. I'm putting bids out there and letting the market come to me and just nibbling away. I can't believe where MJ is trading. 23 and change? Stock was 27 when Constellation Brands put $5 billion into Canopy. Now we're above $8 billion from Constellation, Budweiser, InBev, and Altria, Philip Morris. And the stocks are trading down below that price. It blows my mind. It's such a gift what's going on in this space that I look for ways to put on some positions and just, I'm just putting out some bids and seeing if things hit. I'm certainly not recommending you buy anything. I don't have risk on anywhere in any of our algorithms. So best to stay in cash. Best to stay in cash. But for those aggressive accounts and my own personal capital, I'm looking for a way to get some exposure with very little risk. Maybe the options market is the place I'm going to go. Anyway, you guys have a great day trading. Be safe. I'll talk to you again tomorrow. Thanks a lot for being with me. Take care.